Welcome, everybody, to the June 2024 Reads Report. So, today we're going to start off looking at the markets in play. And one of the things that we're going to see is the yen continues to show weakness. We've been talking about the issues in Japan, and the yen continues to kind of sit on the proverbial cliff. And we see that. We look at a number of the top FX crosses. We see Swiss yen, sterling yen, Kiwi yen, Aussie yen, Euro yen, all above 80. We see fixed income showing up as weak once again, and that's after the break, after payrolls on Friday. We're going to spend some time today talking about the stock indexes. There's some major divergences or bifurcation showing up in the indexes. So we have NASDAQ and S&Ps making new highs, and then we have a number of indexes in Europe that are kind of hanging out by the highs. We have Bitcoin, which we're going to talk about today, that is potentially getting poised for a really big move. We have some of the grains that are showing some weakness, and then we're continuing to see continued strength in a number of the ETFs in Europe. Not new highs, though. That's one important point to note, but hanging out near the highs. And in the sector ETFs, we're seeing XLK and XLC, basically these technology big cap AI stocks continuing to hang around. In the WAMRO Strength Report, I want you to notice the top three. If we look at the top movers up and the top movers down, this is actually part of the story that we'll talk about this month. Look at the top two movers up, NASDAQ and S&Ps. Look at two of the top three movers down, Dow and Russell. So we have indexes going opposite directions. In the sector ETFs, XLK and XLV are the big movers up. Moving down, we have XLB, XLI, which is the Dow. We have gold miners, and we have energies. So with that, I'm going to turn it over to you, Mark. I'm sure we got some really fun stuff to talk about today.
Yeah. All right, so we have pretty much the same sort of narrative that we had before. Rate cuts begin by September to December, and it's kind of switching back and forth depending on how soft the data are. 1 to 2 cuts. We'll probably have a shift in that in one way or the other off the FOMC meeting on Wednesday. Basically, the second part of the narrative is we get a soft landing without much significant deterioration in growth. We've had a little bit of scare in terms of growth, but with the labor report, that's popped right away. And then set for a strong 10 to 12% earnings growth for 2024 with significant additions from AI, and then no geopolitical or domestic political risks that really rock out of control. So that's kind of the narrative that we're in. As long as we're going to be sticking roughly with that, market's going to have probably an upward bias. But if one of those legs starts to come apart, that's where we're going to have trouble. Right now, we're kind of crawling up a wedge formation. Sometimes wedge formations form tops, but this has broken. The NASDAQ and the S&P have both broken out to new highs. So you want to be careful about fading it and wait for a clear signal. So the real driver market really since last July has been long bonds, right? We had the breakout that we talked about in late July that kind of started the equity correction. So TNX rates broke out, the correction started. Really, the stock market didn't bottom until we got a nice double top and big breakdown here, and that put in the bottom in the S&P. S&P started running, and until we got a real breakout above this 4.4% level around here, that's really when we had kind of a minor correction into that April, May, and then as soon as we broke down from head and shoulder in the TNX, then the market really started to move up again. It's just important to understand that the long bond and the TNX rates really are still an important driver. And yet recently we've had a lot of volatility in long bonds because of the differing data, right? So we had a lot of data sort of gang up saying that maybe we're starting to slow down more materially. Right? ISM manufacturing, ISM services, JOLTS, ADP employment, all those things started to allow rates to come off. And then non-farm payrolls on Friday were really off the chart, stronger than expected, higher than the largest estimate. And that sent TNX rates up basically almost a 25 basis point hike. So we really have to understand that bond markets are still a heavy driver, and really pay attention to the reaction in bonds from things. And bonds started to kind of think about maybe more slow growth until that payroll report, that it really knocked the things down. That means, first of all, the NFP report suggested job growth remains robust. But what it really means is that there's still some analysts that are citing this a dozen or so studies showing slowdown. Some analysts saying, oh, it doesn't matter if the job market's still hot. So we really want to brace ourselves for Wednesday. It's a big day to day. We get not only core CPI inflation in the morning, just the open, but then we get the FOMC decision. And it's an FOMC decision that includes a new dot plot. So it has a lot more information than you normally get. And the dot plot will tell us whether the FOMC agrees with the market. The market right now is sort of anticipating just about 2 cuts, maybe a little inch off 2 cuts between 1 and 2, but really heavily towards 2. And so we're going to see if the FOMC agrees with that or not. And if it doesn't, that there could be a reaction. Many analysts are suggesting if the FOMC may anticipate 1 or even no cuts, since we've had such strong job market and really the inflation data is not coming down. Now, if the CPI is really weak in the morning, that may change that, but that's kind of where we are. You want to focus on the bond reaction to this variable on Wednesday. The other thing the market is really going to be focusing on Wednesday is any kind of talk about, there's not going to be any rate cuts. The market's very sure about that, but they're going to be looking for discussions from FOMC members about the R star, right? R star is that neutral rate that the Fed kind of estimates, and it uses to tell how tight policy really is. And so we've had a number of articles by a lot of fairly prominent economists, including Larry Summers, former Clinton Treasury Secretary, and Dudley, who was former New York head of the New York Fed, that have both suggested, and there's more, there's several more analysts that are in on this, that basically saying, look, we've had rates. Supposedly, the R star is estimated by the Fed to be somewhere between 2.2 and 2.3%. Well, if that's the case, sitting at 5.3, we've been over a point above our star now since July of last year. How come the economy isn't slowing? And so the labor market isn't slowing, inflation is kind of going back and forth, not really coming down to target, and the economy really isn't slowing down materially enough to put a solid dent in inflation. So why is that important? Well, if there's, for example, the Dallas Fed President Logan has been one of the first ones to say, gosh, maybe these guys are right. Maybe our R star is just way low. Well, that means 2 things. If we get more Fed officials talking about that, that means 1, that either they're going to have to raise rates further, or 2, they're going to have to leave rates at this level for a lot longer than they've been anticipating. So the market's going to be watching that. And then, of course, we get a press conference from Powell that's always a wild card you want to be aware of. So there's a lot of things on Wednesday. Could be a volatile day, and the reaction of bonds and the spillover to stocks is going to be really important. The other thing that we want to be talking about when we talk about bonds is that we're getting close to the point where we've had some days where we had negative growth reports, and it was good for bonds. It was kind of neutral for stocks. The techs were able to still rally, but the broad market actually didn't. And that's a shift. And we want to keep a real eye on that shift. If we get to the point where bad news for the economy becomes good for bonds, but bad for stocks, that's when we know, okay, we're in for a more significant correction, because the market is really starting to discount a bigger slowdown than we've had. So we want to keep an eye on all that. There's a BOJ decision. Still sounds like Chuck's going to be talking about the yen. We'll talk about it a little bit, but basically BOJ decision on Friday. And what the market is really watching is there's not likely to be any rate move, but it's going to be how much or whether it reduces its bond purchases. And we want to watch the reaction in JGBs and in the yen closely. And as Chuck said, we're kind of teetering on the edge of the cliff of where we've had now 2 sets of intervention to defend the level, and it really has not held for very long. Then we have some other things coming out late this week. We've got the Apple Worldwide Developers Conference today. It looks like it's just a kind of a ho-hum. We've got earnings from Oracle Tuesday after the market close, AVGO Wednesday after the market close, and Adobe on Thursday. Those will help kind of set the tone for the big tech, big caps that are really the main leaders again by a long shot, while the rest of the market is deteriorating. And then we also have that could be a surprise move, and you want to at least be aware of it. The G7 summit starts Thursday in Italy, and Biden is expected to try to convince the Europeans to help him steal. So they froze central bank assets, Russian central bank assets, which means that they're just sitting there. They're still technically owned by the Russians, but they can't access them. That's what they did in 2022 after the Russian invasion. And that was a shocker to markets and led to all kinds of shifts away from dollar reserve assets for global central banks as the sanctions have increased and stuff. We've had more of that. So that's really an impetus behind central bank buying in gold and central bank selling of treasuries that's putting upward pressure on interest rates. But this plan is just way beyond that. The plan is not just to freeze the assets, but to steal them. So they're actually going to take the property, the rightful purchases by the Russian central bank on behalf of the Russian people to buy US bonds. They're not only going to freeze them now, they're going to sell them off and give the money to Ukraine. That it's a ridiculous plan for foreign central banks. That is technically a default. And just think about that. If all the US needs to do is write a stroke of a pen and they can steal all your central bank assets, who the heck wants to hold dollars? Not very many people. You better be in the direct orbit and know that you're not going to have a problem. And so that's something really to watch. Again, the whole sanctions that they did by freezing things and stuff, it's really backfired. Russia has basically gained more than they've lost from the sanctions. Even the Biden administration actually uses the term backfire for what's happened as a result of the sanctions. Think about it. Biden said that the sanctions were going to crush the Russian economy and turn the ruble to rubble. Really good headline. Well, Russian GDP is growing at 5.4% right now versus 1.3% in the US and 0.4% in the EU. So the only people that got crushed were the Europeans. Russian debt to GDP is just 17.2%. It's over 100% throughout Europe and the West, and it's close to 130% in the US, depending on how you calculate it. Russian unemployment is at 2.7%, much lower than 4% in the US and 6% in the euro. The ruble didn't turn to rubble. It's down versus a dollar, some, but it's down versus a dollar similar to a lot of Europe. And then Russian central bank reserves have actually increased by 50 billion from the rise in gold because they've been accumulating gold. And of course, Russia has been able to pay for the war with its increased trade to other countries as a result of the US and Western sanctions. So these things have really backfired, and this is another plan that looks likely to. The Biden plan is to steal over 300 billion of Russian central bank assets that were frozen. 2/3 of these are custodied in Europe. And so he needs to sell this to Europe and get Euroclear to go along with it. Well, Russia has already announced that it's going to basically, have repercussions. Russia will freeze much more assets than and seize them in Russia, then from the West, then the West is going to be able to seize. So that's going to be a negative. And then also Russia is already starting a lawsuit against Euroclear in areas that are Russia friendly, including Hong Kong and Dubai. If any of those locations decides with Russia, which is almost a sure thing, they'll be able to enforce that anywhere. That will cause basically the whole loss to go to Euroclear, and that could cause a financial problem. So we really want to kind of be careful. Somehow they just don't think through what are the counter moves to the policy that we're doing. They just think that the world's going to go along with whatever they say and say, yes, sir. And that isn't the way the world works. And it's hopeful that they can't convince Europe to do this, but we'll have to see. If they do, it could be a problem for markets, could be more gold buying and more bond selling. All right, as Chuck said, we got a lot of divergences. Is 3 of 6 of the major internals have broken the July levels, which means that 3 haven't. So it's about 50-50. That leaves the market with a positive bias, but it's not fully all cylinders in gear to the upside as you'd like to see for a really aggressive backdrop. And if we look at our supply and demand, they've just been a mess in a trading range. None of them have broken their significant July levels. So the market is really kind of broad market, kind of in a range, and super strong. Particularly large cap growth and certain tech sectors are really the main things that are rising. So you want to realize this is the rally broadened some off of the late October lows, but now it's narrowed again, and that's a problem. We have a lot of Hindenburg omens, not really the whole bunch in a row that we typically get at intermediate term tops, but we've got several of them, and usually within a month of those, if you have big divergences in the NYHL, and we have months of divergence in NYHL, and we have multi-weeks, more than 3 weeks in the OCO advanced decline line. For the NICE, that's a setup that says if we get a correction warning, then it will likely be a bigger than normal correction. So you want to realize that we're in a situation where the divergences are building, which means that if we get a correction warning, you have to prepare to hedge yourself more than we have at any time since 1922, really. We are very close to a correction warning. We really need one set of things to happen: really strong volume traction, low close, strong plurality decline in the market. That's going to set us off. So we want to be careful, particularly with a big news event that could turn the market either way. And you want to be aware and maybe get your ducks in a row for hedging or for what you're going to sell or what you're going to do if we get an intermediate term warning. The big problem still remains small caps, although mid caps are also quite divergent. You can see that small cap relative strength is now making new lows, and small caps are kind of playing around with a level that's a decent support zone that if it's broken, that's going to be more bad news. We have strong action from, as I said, large cap growth, semiconductors in particular, some software, some tech groups, and then also India and Europe. We do have new highs in Denmark and Ireland, but outside of that, the strength is waning, particularly in Asia, where we've got some negative markets. The other thing is not just the advanced decline lines that are diverging significantly. It's a lot of the economically sensitive groups like financials, transports, small caps, and even equal weights. They're all, the S&P is making new highs. All of these are divergent from weeks to months. And that's a growing concern. Now, the thing to realize is if building to a major top, you can get divergences like that go for many, many months and even as long as a year. So you don't, because you have the condition of divergence, you don't want to trip all over yourself and say, that's it, I'm out of here. But you also want to be careful about adding new things, stick with the very strongest things, and be prepared to shift gears. We also had what we call a McClellan trio condition, right? And that's where that's something we teach in the market timing. It's been a very good signal. once you get a correction warning after that, that you have a bigger than normal correction. And sometimes they come very close to actual highs. It's when you get a new high in the S&P, both the Nice-McClellan oscillator and the Nice-volume McClellan oscillator are below zero. And at the same time, the ratio adjusted Nice summation index is below plus 500. Had all of those on Friday. Again, it's important to understand these are conditions. They're not a signal. You need a signal to validate any condition. Sometimes you get divergences and the market just kind of continues to grind higher, and eventually they burn off and there's no divergence anymore. So you want to be prepared for a warning signal that you need to get very concerned, but you also want to be aware that we're close enough to a signal and we've got enough divergence that we want to be very careful about a signal if we get it. We could certainly have a choppy backdrop if we do not get a signal to the downside. This is a kind of indication, really the only segment of the market that's moving in the right direction and in the upper quadrant and making new highs and relative strength is large cap growth. So that's where you want to focus. In no other segment is making new highs here, and all of them have poor headings on the charts in terms of the RRG charts. And the advanced decline lines aren't just for the Nice, they are for a lot of things, even large cap. We have at least this 3 weeks of divergence from mid-May with all of the main advanced decline line segments. And of course, in the small cap, it's well over a year. So that's the real weakness, small caps, and the real strength is large cap growth and techs. So you also want to start watching support carefully when you get this much divergence and when you get close to correction warnings. Really, the first layer of support watches uptrend line from the late October lows. And then the second one is through this area where we had our support zone around 51.80 that the market fell to and then has bounced off and made new highs. So that's going to be a really key level along with the 50 DMA that was right there. And you've got this situation where we had new highs in the S&P on a day when actually there were more 52-week lows than 52-week highs. It's very rare, but you can see that the outlook for the next 3 months is not that great. And even for 6 and 12 months, it's barely positive. So it's certainly possible we could churn around for a while. Another thing to note is that when the largest 50 stocks of the S&P are really more than 3 sigma higher than the rest of the market, that tends to be a real warning sign that you see 3.5 or 6 is a level that's corresponded with major highs. So we're getting that all just symptoms of the narrowness of the market. And you want to consider, just like the internet, it was a huge change to mankind, but of course the market over anticipated how fast it would impact earnings. It's not impossible that we get that with AI. The AI that's really doing well right now is the pick and shovels, right? The NVIDIAs, the people that are selling their basically tools to go mine in the AI universe. We're still not having a lot of huge kicker on earnings yet from people using that technology to really change and grow. So we want to just be aware that sometimes when new technologies come out on a long-term basis, they can do fabulous things, but on a short-term basis, usually the market over extrapolates when it's really going to be impacting earnings. And there's a lot of evidence of massive speculation in the market, right? This is daily. This is options that expire on a daily basis. And the volume is unbelievable. This is like betting on red or something, for one toss. And then retail net purchases of leveraged ETFs is through the roof, and penny stocks are through the roof. These are all indications that we have excessive speculation. That doesn't really mean anything in terms of market timing. But again, it's part of this backdrop that kind of adds up to higher risks than you really want to not be aware of, at least that there's very high risk. And we've talked about valuations. Valuations are in the sky. They're not in outer space, but they're getting close to those levels. And certainly these are levels that, in 2000, it was higher than in 1929. And we kind of went just a little bit beyond that. And then we've gone beyond that in 21. And now we're getting up there again. Just realize that historically, you get anywhere close to these, eventually it ends in tears. And then the other thing that you want to understand is that this is a percentage of stocks that have outperformed the index. And of course, at major tops, this gets really low because we get very, very narrow, and it's the big caps that are leading. In that environment, it gets harder and harder for investors to outperform or even keep up with the indexes. So in that environment, the reward is kind of falling off. There's not as many stocks that are really outperforming. Let's see. So Wednesday, of course, we've talked about it. We get the CPI and core CPI and FOMC, and then we get the BOJ and G7, and really how we respond to that, whether we get a signal, whether that improves things and we go another round, really could hinge on how the market reacts to that. And we've talked about how bonds have really been the leader, and we really want to watch the action in bonds. What I would say is we can see cloud front. We don't know if it's going to pass over there or going to pass over us. So you really want to take both your rain gear and your sunglasses, because you don't know what's going to happen, but you know something will. So you keep raising your trailing stops, you watch internal signals, you're ready to switch gears while continuing to play things as far as they run. And then we've got a number of recession warnings.